All right, hi, welcome. We're going to talk about aggregate demand and aggregate supply today. It's chapter 28 of your books, and it's in pages 732 to 749. And the goal is to talk about both what is aggregate demand and aggregate supply, as well as why the curves are sloped the way they are. And we'll talk about reasons why both of the curves will shift. And we'll also look at the difference between long run and short run aggregate supply and why there's a difference in those two curves. When we start, let's look at aggregate demand. The idea of aggregate demand is it shows a relationship between the price level, the overall price level within an economy, and the amount of output demanded by both households, firms, government, and the rest of the world. So when you draw a aggregate demand graph, make sure that the vertical axis, if you're going to label it, is the aggregate price level. It could be CPI, it could be GDP deflator, some sort of price level that measures aggregate tendencies. And then on the horizontal axis is real GDP. And we see that it's downward sloping because as price levels drop, as things get less expensive, we begin to see that the quantity demanded increases, and there's several reasons for why that would be the case. One is that if we have an increase in our wealth, which is what essentially a drop in prices indicates, then we'll want to consume more. So lower prices means we feel relatively more wealthy, and therefore we would want more goods. Also, when there are lower prices, it means there's less competition for money. And if there's less competition for money, if people aren't competing to try and borrow more, but instead have money that they're offering to lend to other people, that has a negative impact on interest rates. It causes interest rates to drop, and we'll talk more about interest rates later in the course. But interest rates will drop, and if interest rates drop, it becomes more advantageous for businesses to invest and for consumers to borrow to consume, and that then would lead to greater aggregate demand. And finally, lower prices means that goods that are domestically produced are now more competitive than they are than our imported goods, and so we see our net exports begin to rise. We begin to trade off. Instead of importing goods, we just buy the domestic. And so when we look at the GDP equation, we see that consumption increases with a reduction in overall prices. Investment increases with a reduction in overall prices. Presumably government spending will increase with a reduction in overall prices, I suppose, but net exports certainly will. So that's the three primary reasons why the aggregate demand curve slopes downward. The wealth effect, by the way, is something that you can actually see and read about. This is an article from the Washington Post in 2012. And Ben Bernanke, who was the Fed chairman at the time, said that as interest rates are being pushed down across the board, it increases the value of assets that people own, such as stocks and real estate. And he argued that owners who feel wealthier are more disposed to spend. So when people feel wealthier, they demand more goods, and that's what our aggregate demand curve tells us. Now, we do make a distinction between what's known as a shift in a curve and a movement along a curve. If there is a change in the overall price level, we say that's a movement along the curve. We just go from one point on the curve to the next. But sometimes the curves will actually move or shift either to the right or the left. That indicates that there is now a change in the amount of goods demanded at a certain price level. And so a rightward shift would indicate an increase in aggregate demand, whereas a leftward shift would indicate a decrease in aggregate demand. So when there's a change in the price level, we go from point 1 to point 2. So price level drop, we want more stuff, but our willingness to buy stuff hasn't changed. When there's a shift, what that says is that if the price level were X, then instead of wanting this much output, we now want the previous amount of output plus a certain amount, and that would be the case for every single price level, and that would then be a shift. Anything that causes a change in C, I, G, or net exports is going to be a shift. So changes in expectations, changes in wealth, changes in existing stock of capital, what's known as fiscal policy and monetary policy will all cause shifts in aggregate demand, and we're going to deal with each one of these things individually. First, when it comes to changes in expectation, if you expect a strong economy, then generally speaking, you would then be willing to spend more than you were before. So it doesn't matter what the price is. If you think the economy is strong and your prospects are improving, you tend to spend more. Investment also kind of occurs as people expect a stronger economy, as businesses have a higher expected rate of return. Investments begin to make more sense economically. And when that happens, we see a shift to the right in aggregate demand. If we see the opposite, then it would shift to the left. Consumer confidence here is really important, and we can actually kind of track it historically. If we look at this graph and we see the little shaded areas in gray, that's recessions, and during recessions we see that consumer confidence, overall belief in the health of our economy, tends to dip during the recessions and goes back up again during boom times, and dips during recessions and then goes back up again during boom times. So people's expectations are very important to overall aggregate demand. We also look at changes in wealth. If your wealth increases, you have more purchasing power. If you have more purchasing power, presumably you will buy more stuff regardless of what the price level is, and we would see aggregate demand shift to the right. If we saw wealth decrease, it'd be the opposite effect. Changes in physical capital are another thing. If production is at or near capacity, then businesses need to invest to purchase more equipment, more capital, in which case that would fall under I in our GDP equation, and we would see real GDP increase. And so anytime that production gets right up close to or at capacity, we begin to see more investment and a shift to the right. If there's less investment for some reason, aggregate demand would shift to the left. And then changes in fiscal policy. Fiscal policy is the government's policies related to taxes and spending. And we'll talk more about fiscal policy later in the course, but just as a basic overview, the government, if it increases its spending, will increase aggregate demand at all price levels. So when the government decides to start a new program, we would expect aggregate demand to shift to the right. Also, we might see changes in tax policy, for example, that would also affect aggregate demand. So government, if they choose to reduce taxes, that would make people relatively more wealthy than they were before, and therefore we would expect to see a rightward shift in aggregate demand. And if they were to raise taxes, we'd see the opposite effect. And then monetary policy, another thing we'll talk more about. This is managed by the Federal Reserve, and that's just kind of managing how much money is available in the marketplace or in the economy, as well as interest rates. And we see that if there's more money put into the market, there's more money to lend, which has a downward pressure on interest rates. And with lower interest rates, it means that more investment projects are economically feasible, and we would see a rightward shift in aggregate demand. Also, with lower interest rates, consumer spending is less expensive if that spending is fueled by debt, and so we would see an increase in aggregate demand.